So if everyone could sit down, you were already sitting down, so I don't know really what I'm instructing you to do, but thank you for letting us start on time, which is always useful for something like this. Yeah, we're good? Okay. Good now? All right. Well, good morning, everyone. Thanks for joining us. This is the first in a new conference series, Tax Reform: Perspectives from Across the Nation. It's jointly sponsored by Tax Analysts and the American Bar Foundation. And it kicks off today and will continue in June with a session at NYU Law School. I'm Joe Thorndike, a contributing editor at Tax Analysts, and I'll be the moderator today. By way of background, Tax Analysts is the nonprofit publisher of Tax Notes, State Tax Notes, Tax Notes International, and a variety of other print and online products. This is our 15th year of hosting public discussions on tax practice and policy. So if you're new to events, let me just say thank you for being here. We're glad to have you. Today's discussion will focus on the prospects for fundamental tax reform, something that by most measures hasn't really occurred since 1986. That legislation has grown a little creaky in the 30 years since, and a wide variety of stakeholders have been clamoring for another run at it. And in fact, they've been arguing for many years, noting that most of our leading trading partners have already taken the plunge. What's new, of course, it's obvious to everyone, is the election result from last November. We now have one political party controlling the White House, the Senate, and the House of Representatives. And to repeat the tired old cliche, the planets may be aligning for another run at tax reform. The House leadership has its Better Way blueprint. The Senate's been working on corporate integration for quite a bit of time. And President Trump has outlined a notably brief but very ambitious agenda for remaking the tax system. We'll get into those details in a little bit, and I'll give you a brief summary for those who aren't following minute by minute exactly what's going on in Washington. I'll give a summary of those, at least the House and the administration plan. But I'd like to take a moment to explain our process. We're going to all offer some introductory remarks. I'll make some originally, and then I'll hand it off to our speakers. They'll address whatever specific aspects of the topic they choose, and then I'm going to open the discussion to all of you. And I want to emphasize this. I'm really hoping that you'll feel free to ask all of us and to jump in when it seems relevant to you. We're recording this event for viewing on our website, which is why we have all the cameras. For media purposes, we are on the record. And for that reason, when you speak, please try to tell us who you are and what organization you're with. In the coming days, we're going to post a copy of today's event on the website, taxanalysts.org, so be sure to look for that. Before we proceed, I'd like to thank the American Bar Foundation and its executive director, Ajay Mehrotra, over here in the front row, just where he should be, for joining Tax Analysts and sponsoring this nationwide conference series on tax reform. I'd also like to thank Northwestern's Law School, including Dean Daniel Rodriguez, as well as its outstanding tax faculty, one of whom is up here with us today, Charlotte, at the end there. Now, these panelists we have up here, we organize a lot of events every year and have done it for years, but this is a really great and outstanding group of panelists, and I would be remiss if I didn't thank them for taking the time to be here as well. I'm going to do the introductions, and then I'm going to jump back to me for a little while and give you a little summary of the plans, and then they'll take off. To my immediate left is Eric Solomon. He's the co-director of the Ernst & Young National Tax Department in Washington, D.C. He served as Assistant Secretary for Tax Policy at the Treasury Department from December 2006 to January 2009. For those of you not from Washington, as Assistant Secretary, he headed the Office of Tax Policy, which serves as the primary advisor to the Treasury Secretary on legal and economic matters. Seated next to Eric is Peter Blessing. Peter is a member of the Complex Transactions Group of KPMG and their Washington National Tax Practice. Prior to joining KPMG, he served for 25 years as a partner at Shearman & Sterling, a leading international law firm. He's president of the International Fiscal Association USA, as well as past chair of the New York State Bar Association Tax Section. Next, at the end, is Charlotte Crane, a professor here at Northwestern's Pritzker School of Law. Charlotte's academic research and teaching focuses on the problems of defining broad-based taxes and the mechanisms through which those rules evolve. And I have to point this out because it pleases my historian's heart. She also specializes in the history of various tax institutions, especially in the early republic years of American history. Now, on to the subject at hand. When we held our first conference in this series a couple of weeks ago, all eyes were on the White House, which had just released its revised tax plan, which you actually have probably picked up as you walked in. The outline was widely noted for its brevity and its general consistency with President Trump's more detailed campaign statements on tax reform. The plan joined a policy debate that had been more or less dominated by the House of Representatives' Better Way for Tax Reform proposal, commonly known as the Blueprint. In addition, the Senate had been working for months, maybe years actually, on an unspecified and still undefined proposal focused on integration of the corporate and individual taxes. When the administration released its plan, Treasury Secretary Mnuchin assured reporters that the White House and congressional Republicans were 100% in sync. On Capitol Hill, GOP leaders were a bit more restrained. House Speaker Paul Ryan said that they were 80% in agreement, with the remaining 20% in the same ballpark. House Ways and Means Chair Kevin Brady echoed the 80%, calling it a common ground and a commonality. It's worth pointing out that Brady at the end of March said that they were 90% on the same page, so we've lost a little ground. But when I've heard those assessments originally, I thought, hey, that's pretty good. 80% is a lot of overlap. And then my daughter pointed out to me after a trip to the Natural History Museum in DC that human beings and domesticated cattle have an 80% overlap in DNA. And I thought, huh, all right, the last 20% can actually make a difference. Yeah, I'm the kind of guy that talks to his 14-year-old daughter about tax reform, which tells you more than you need to know about me. All right, so points of comparison. I'm going to try to do this quickly between the Trump plan and the Blueprint. I'm indebted to Eric for providing me with a really great summary. I should really let him handle all of this, but instead I'm just going to mangle it. All right, so on the individual side, both plans, the Trump plan and the Blueprint, would cut the number of brackets from 7 to 3. The numbers are not that far off in terms of the rates that they would use, although there's an odd lack of bracket definition in the Trump plan. They identify what rates they want, I think 10, 25, and 35, but they don't tell you where those brackets begin and end, which is strange for brackets. Both would roughly double the standard deduction. Both would repeal the individual AMT. Both include significant breaks for investment income, preserving preferential rates for capital gains, dividends, and interest. There's some minor difference in rates there. Both would eliminate the 3.8 net investment income tax for individuals. Both plans would create a preferential rate for pass-through income, the House at 25% and the Trump plan at 15%. Both promise some amount of base broadening, perhaps a lot of base broadening. Trump has said he would preserve the mortgage interest deduction, charitable giving, and retirement savings incentives. Everything else is on the block, including specifically the state and local tax deduction. The House would hit state and local tax too, and they apparently are open to changes on some of the others, like the charity and the mortgage interest deduction. Both plans would repeal the estate tax, and now, having buried the lead, this is in many ways really a debate about corporate tax reform or business tax reform. Both plans would lower corporate tax rates. The Blueprint would cut the top corporate rate to 20%, Trump's to 15%. The House would eliminate the corporate AMT. I've seen some indication that the administration is open to that idea as well. Expensing, the House has it, Trump doesn't, but might eventually. They've shown some interest in there or some receptiveness to it. Trump would preserve interest deductibility, probably. The House would eliminate it. Both would move the U.S. corporate tax to a territorial basis going forward, and both would impose some sort of mandatory tax on previously untaxed accumulated foreign earnings, regardless of whether or not they're repatriated. Trump doesn't specify the rate of that tax. The House would use a rate of either 8.75 or 3.5%, depending on what sort of assets, what sort of earnings we're talking about. The big issue here, though, really, the 20%, I mean, it's got to be 15 of that 20%, is the destination-based cash flow tax that is a marquee provision of the Blueprint and was notably not embraced by the president. It's a border adjustability, it provides for border adjustability in which exports are exempt from tax with the cost of goods sold remaining deductible. All imports would be non-deductible. It would apply to services as well as tangible and intangible property. I would say that the door has not quite been closed by the administration on this tax. They keep saying that with appropriate changes that they would be willing to talk about it. It's not clear to me, and I plan on asking our panelists today what they think those changes might be. But at least there's a little light still. The president seems to favor some sort of reciprocal tax, but I'll let the panelists sort out what that means. To my reading, it means a tariff, actually, and not anything else. But in any case, the 20% looks pretty big to me after running through that list, especially around the destination-based cash flow tax, and possibly around the larger issue of cost. because the House is still at least notionally committed to deficit neutrality. The administration is explicitly not committed to that. And there's been some backpedaling. You know, Senator Hatch has shown some willingness to have a tax reform plan pass through that was losing a lot of money. So, you know, the estimates on what the cost of these things are basically impossible to come up with right now, especially for the Trump plan. But at the Committee for Responsible Federal Budget, the deficit hawks extraordinaire in DC, they pegged the Trump cost at something like 3 to 7 trillion over 10 years. Yesterday, the Tax Policy Center took a look at the pass-through provisions and scored it for both the 15% rate and the 25% rate. And at the upper end, using the Trump figure, they said it might cost as much as, I think it was 2 trillion over 10 years. All right, so without all that said, you can keep all that right at the tip of your tongue, right? So you'll be ready to ask the questions. I'm going to turn it over to Eric to start, and we'll go in order down the table.
Thank you, Joe. Just very briefly, I'm sure everybody's aware of why we're going through this exercise. You know, why tax reform? And I'll just spend a very brief minute on that. Looking on the business side, at corporations, we have a high statutory corporate tax rate, 35%. Now, the code is filled with many special provisions and preferences. Focusing on the business side, on the corporate side, I would describe our corporate tax system as lumpy. That is to say, there are some corporations that will pay tax, federal tax, at the high 35% rate. Others enjoy the various provisions and preferences and pay an effective rate that's much lower. So we have a lumpy corporate tax system. And of course, we have a double tax system. For years and years, there's been discussion of integrating our corporate tax system. That is to say, a corporation pays tax on its earnings, and then when those earnings are distributed to shareholders, there's a second level of tax. So the corporate tax is viewed as a very inefficient tax. In addition, focusing on our business tax system, our international tax system is a deferral system. And so the way it works is if you have a U.S. corporation that owns a controlled foreign corporation, the controlled foreign corporation earns active earnings in France. Those active earnings are subject to French tax, but they're not subject to U.S. tax until they're brought back to the United States. So we have what's called a deferral system. It results in a lockout. Enjoy the various provisions and preferences and pay an effective rate that's much lower. So we have a lumpy corporate tax system. And of course, we have a double tax system. For years and years, there's been discussion of integrating our corporate tax system. That is to say, a corporation pays tax on its earnings, and then when those earnings are distributed to shareholders, there's a second level of tax. So the corporate tax is viewed as a very inefficient tax. In addition, focusing on our business tax system, our international tax system is a deferral system. And so the way it works is if you have a U.S. corporation that owns a controlled foreign corporation, the controlled foreign corporation earns active earnings in France. Those active earnings are subject to French tax, but they're not subject to U.S. tax until they're brought back to the United States. So we have what's called a deferral system. It results in a lockout effect because if you earn money offshore, particularly in a low-tax jurisdiction, you don't have an incentive to bring it back to the United States and have it taxed when it's brought back at the U.S. tax rate. So we have an international deferral system that encourages companies to earn money offshore in low-tax jurisdictions, low tax compared to our 35% rate, and then encourages U.S. companies that have foreign operations and foreign subsidiaries to leave the money offshore. And as everyone knows, there's more than $2 trillion sitting in foreign subsidiaries of U.S. companies. In addition, under our current system, there are incentives to use debt because interest deductions reduce U.S. tax. Of course, our system is very complex. So for all those reasons, there's been discussion about tax reform. And another aspect of tax reform is there's a desire to promote economic growth. There are certain changes that could be made to the tax code that economists believe will promote economic growth. One of those principal ways to do that is to encourage capital investment. And you might encourage capital investment by having expensing, which is writing off all investments when they are made. Our current system is a depreciation system. It allows recovery of costs for capital investment over a period of years. Economists believe that if you move to expensing, that is to say an immediate write-off, it'll encourage capital investment, which is very important to growth. In addition, another aspect of promoting economic growth is lower tax rates on individuals. Consumption is a very important driver in our economy, and if you lower tax rates, it encourages economic behavior, particularly consumption. And so tax reform can contribute to economic growth, both from expensing and from lower tax rates. Now, in terms of some of the open issues that need to be addressed, first, just as a point, the discussion of tax reform has been going on now for more than a decade. We can look back at least 10 years to see the discussion of tax reform. In 2005, President Bush commissioned a panel to study tax reform, and the 2005 study gave two proposals. One proposal was a simplified income tax. The other proposal was a growth and investment tax called the GIT, and which looks a lot like the blueprint. That is to say, if you look at the blueprint, you can see a lot of aspects of the blueprint that are reflected in the 2005 Bush Commission report. So in addition to all the discussion that's happened, including the 2005 Commission, in addition, there's Congressman Ryan, Chairman Ryan, issued a bill, the Tax Reform Act of 2014, H.R. 1, which was a comprehensive tax reform plan. We also have the House Blueprint, which was released last year, which is a framework for tax reform from the House Republicans. And of course, recently, at the end of April, we received the administration two-page proposal for tax reform. So in terms of where we stand, these are the foundation, these are the building blocks for moving forward on tax reform. There are a number of outstanding issues that need to be resolved if we are going to accomplish tax reform. And I'm briefly going to go through them, and hopefully they'll be the basis for further discussion. The first question is a question of process. Is it going to be bipartisan? If not, there are special procedures, as you know, that will be used to move forward on tax reform called the reconciliation process. As of this time, most observers believe that it's not likely to be a bipartisan process, in particular because Democrats would not be in favor of lowering individual tax rates on high-income earners. And therefore, there is a basic issue with respect to lowering tax rates on the individual side that would probably be an impediment to Democrats going along with tax reform. But we will have to wait and see how this moves forward. It's too early to tell whether or not that will in fact be the case, but that certainly appears to be an issue. If it's not going to be a bipartisan process, then in the Senate, there is the possibility of a filibuster, which means that you would have to get 60 votes in the Senate to overcome a filibuster in the Senate. As you know, the Senate is relatively evenly divided. So in order to overcome the filibuster, you would have to use the reconciliation process in the Senate to enable passage of tax reform in the Senate with only 51 votes, or 50-50 with Vice President Pence voting on the Republican side. But the reconciliation process comes along with it various protections for the minority. And there are various limitations on the budget reconciliation process. One of the main ones is that under a budget reconciliation bill, it can't increase the deficit after the budget window. So if the budget window is 10 years, then under budget reconciliation, a tax bill cannot lose revenue after 10 years. So the first question is a question of process, whether this will be bipartisan or whether we use the reconciliation process. The second issue is the interaction with the health care bill. Interaction with the health care bill at least on two levels. First is the question of timing. As everyone knows, the health care bill passed the House recently by a closed vote, and now the health care bill is in the Senate, being considered in the Senate. As a question of timing, how quickly will the Senate address health care? As everybody knows, there are various different groups in the Senate, both Democrat and Republican, that have various interests in the health care bill. For example, there are Republicans, for example, that are very interested in the issue about Medicaid expansion. And so how will that play out in the Senate, and when will that play out in the Senate? But clearly the deliberations in the Senate with respect to the health care bill are going to have an impact with respect to tax reform, because of all the activity in the Senate will take energy and time away from moving forward with tax reform. And I'll talk more about timing a little bit later. In addition, the interaction with the health care bill, because as you know, there are various provisions, tax provisions, that were enacted as part of the Health Care Act in 2010. For example, one of those provisions was the 3.8% tax on investment income. And the question is whether or not that might be repealed as part of the health care process. Now, the original health care bill that didn't come to a vote would have repealed the 3.8% tax. But whether or not the provisions in the health care bill, the tax provisions in the health care bill, get separately acted upon in the health care bill will affect the tax bill. And, for example, will also affect the baseline for the tax bill. For example, if the 3.8% tax is not repealed in health care and Congress decides they want to repeal it in the tax reform bill, well, that is an additional expenditure of billions of dollars that might have to be offset. The next, which leads inevitably to the next question, is will the tax reform bill be revenue neutral? As you know, in the House of Representatives, Chairman Brady and Leader Ryan have talked in the past about having a revenue neutral bill. Well, one of the questions is, well, what do we mean by revenue neutrality? How do you define the baseline? And we can have a whole discussion about how you measure the baseline, but just in interest of time, we're not going to go through. But the notion of a baseline is not a clear and certain thing. Also, the method of scoring. How would you go about scoring a tax reform bill? Would you use traditional scoring, or would you use dynamic scoring that takes into account more of the feedback effects of a tax reform bill on the larger economy? And then over what period would you measure revenue neutrality? And then a very important issue that's going to have to be addressed is distributional neutrality. The question is, how is tax reform going to affect the tax payments by various quintiles of earners in the United States? Distributional neutrality is going to be extremely important. Now, it's too early to tell from the information that we have about what might be in tax reform, but distributional neutrality is going to be a very important issue that would be part of the debate. Another question is, assuming we have tax reform, how much can rates be lowered? How much can individual tax rates actually be lowered? How much can the corporate tax rate be lowered? There are some who say, well, if you don't lower the corporate tax rate significantly enough, for example, below 25%, it might not be valuable to do corporate tax reform. We have to view tax reform in the lens of considering all the other countries in the world that are lowering their corporate tax rate. And the question is, in order to be competitive, how low can we lower our tax rates, both individual and corporate? The next issue is what deductions and preferences would be eliminated. Joe referred to some of the preferences and deductions that might be eliminated. And of course, I think we'll spend some time talking about the proposal in the blueprint for expensing, and we'll talk about the denial of interest deductions, because they are bookends, and we will discuss expensing and denial of interest deductions. There was discussion in the past of perhaps a transition tax on accumulated offshore earnings to pay for infrastructure. That is to say, of the $2 trillion sitting offshore, one of the proposals is to have mandatory repatriation, to treat it as if it was repatriated to the United States, and that a certain tax rate, perhaps between 8 and 10%, would be imposed on accumulated foreign earnings. The question is whether it might help pay for infrastructure. There were discussions about a year ago between Democrats and Republicans of trying to move forward with some sort of tax reform where the notion of a transition tax to pay for infrastructure was discussed. At the present time, it doesn't seem to be on the table, but of course it could always come back in order to bring Democrats to the table. Two of the most important issues I'll now discuss is what type of international system would we have. Now, it appears that a consensus is forming among Republicans that we would have a territorial tax system. And under a territorial tax system is if you have a foreign subsidiary and it earns income, It would pay the local tax, but when the income is repatriated to the United States, it would not be subject to U.S. tax. It appears that the Republicans are agreeing that we should move to a territorial tax system, and both the blueprint and the Trump plan speak in terms of a territorial system. But if you move to a territorial system, it increases the incentives to move activities and income offshore. Because if the income is not going to be subject to U.S. tax, and you put it in a low-tax jurisdiction, it will never be subject to U.S. tax. So if you move to a territorial system, you have to consider base erosion provisions. And both Democrats and Republicans agree that base erosion is a very important concern. The border adjustment provision that we will discuss, in part, is intended to address issues of base erosion. The question is whether the border adjustment proposal will move forward. If it does not move forward, or if it moves forward in some sort of compromise provision, then the question of base erosion provisions will continue. And so, one way or another, continuing discussion of base erosion provisions is going to be important. And if you don't have the BAT, the border adjusted tax, you have to consider other kinds of base erosion provisions. One thing that's been put on the table is perhaps a minimum tax, and we can discuss whether a minimum tax would be used, whether it would be used by Congress as a base erosion provision. Now, there has been resistance to various proposals about a minimum tax, but the minimum tax may come back as something that's necessary to address base erosion. So the international tax system and base erosion is a critical issue in tax reform. The next critical issue is the treatment of pass-throughs. The Trump administration proposes a 15% rate on pass-through income. The blueprint has a 25% rate on pass-through income. There are many, many issues around the treatment of income from pass-throughs that perhaps we'll have the opportunity to discuss. But exactly how a tax system would work with a special rate for pass-throughs and a different rate on compensation income is a challenge that needs to be addressed. Transition rules, that's a very important issue. Transition rules are going to be necessary moving from the old system to the new system. For example, if you have denial of interest deductions, well, how do you apply that to old debt? If you have expensing, how do you apply that to items that you've been depreciating before the new system is put in place? The more transition you have, the less economic benefit that you get from tax reform. One issue that hasn't been discussed of late is the IRS transformation. If you look in the blueprint, there is discussion about transforming the IRS to a customer service organization, a service-first view. Now, there have been no details about a potential IRS transformation. It's something that will have to be discussed further. One issue of particular concern is the spending side. About 5 years ago, there was a lot of discussion about coupling tax reform with entitlement reform and needing to deal with both sides of the ledger. In our country, we take in revenues and we spend monies. And the question is, well, what about the budget deficit? What about spending issues? Obviously, with the baby boomers retiring, the needs for Social Security and health care are only going to increase. So as we consider tax reform, it's necessary to keep in mind the increasing pressure we are going to have on spending in this country, particularly mandatory spending. The percentage of mandatory spending in our budget continues to increase, and it's above 60% at the present time. The question is whether tax reform is going to be coupled with dealing with entitlement spending. Just a few final points. How are other countries going to react to U.S. tax reform? There has been discussion about the border adjustment tax that other countries might respond to any provision that we might do having to do with border adjustments, that there might be a WTO challenge. And independent of a WTO challenge, how generally are foreign countries going to react to our tax reform? Remember, whatever we do here in the United States, we do not do in isolation. And increasingly so in this global economy, we have to understand that we are not an island here in the United States. And so whatever we do will have effects overseas, other countries, and other countries will react. Another area, not just that what we do for federal tax reform affects foreign countries, state and local taxation. State and local taxation is extremely important, and federal tax reform will have implications for that. Financial accounting. What effect will tax reform have on financial accounting? One might not think that's particularly important, that you shouldn't have the tail wag the dog. On the other hand, which is the dog and which is the tail? It's a very important issue, financial accounting. Just as a matter of experience, if you look back to 2004 for the manufacturing deduction under Section 199, that originally was proposed to be a corporate tax rate reduction. But one of the issues that was raised was its effect for financial accounting purposes, and it was turned into a deduction. So that was one of the reasons for the formation of Section 199 in the form that it was finally enacted. So financial accounting is a very important issue. Then process. What's the process going to be? Well, we have the blueprint, we have the administration proposal. There's been a lot of talk about now the administration and the House and or the Senate together behind the scenes trying to work out a consensus approach to move forward before releasing a bill. So in the coming weeks, we would anticipate discussions between the administration and particularly the House Ways and Means Committee and perhaps with the Senate to try to reach consensus, because right now all we have are a couple of frameworks to move forward before releasing a bill. And finally, timing. We've discussed briefly timing. We have the health care bill. And we have so many other things happening in our political scene at the current time. The question is, what is the timing going to be? Now, I'm sure the Republicans are extremely eager to move past health care and to get that done by the August recess. That would be the best schedule, and that would leave the fall to move forward after the August recess to move forward on tax reform. So just a brief introduction to some of the issues that are raised by tax reform. And with that, I'm going to turn it over to Peter.
Let me just interrupt to say,
sure.
if you guys have questions, please try to hold them till we'll go through all the speakers first, and then I'll come back to all of you. There'll be plenty of time for questions.
Okay. Thanks, Eric. Thanks, Joe. I'm going to focus on the international aspects of the tax reform proposal. And I'm going to talk generally about a sort of a blend of the blueprint and the Trump plan. And so focusing on that, the international aspects are truly transformational. Some other aspects have some very dramatic changes to the tax system, but the international aspects are transformational in a couple ways. The first, as Eric mentioned, the territorial system. And that is something that initially wasn't espoused by Trump. Trump had a full inclusion proposal in his campaign approach. And then he sort of reversed course in April and probably, I think, affected by advisors such as Gary Cohn, who's his chief economic advisor, and probably Treasury Secretary Mnuchin as well. To go to a territorial approach. Now, neither the House blueprint nor the Trump plan make any reference to how they would deal with base erosion under the territorial approach. So they talk about the goodies without the medicine so far. Foreign countries don't really consider this to be a big change from their standpoint. They think the CFC regime with the deferral of income and check the box and so forth effectively produces the same result. A transitional issue in connection with the territorial system is the repatriation tax, and that gets a ton of attention from practitioners because they're looking at the offshore earnings and profits as a bullseye for or a basket into which the government's going to reach, and there's a lot of politicking about the rates and a lot of planning about the base. The second transformational aspect, and the one I really want to spend most of the time on, is the border adjustment provision. So the border adjustment aspect of the destination-based cash flow tax. The proposed regime is described as a destination-based cash flow tax, which means it's composed of several of the other pillars of the blueprint and the Trump plan as well that Eric mentioned, which in particular full expensing, no net interest deduction, and then some sort of border adjustment has a result that produces something very similar to a consumption tax. So that is completely based on, or the transformational aspect of it is based on that border adjustment, because if you think about it, you could very easily, under the current origin-based system, fit in full expensing. Requires a lot of changes to the reorganization provisions and so forth, partnership provisions, but you could fit it in. And you could fit in, and certainly a denial of the interest deduction has been popped up from time to time. So that could fit in conventionally, but the border adjustment aspect is unique. It's also unique in the world, so that's something to remember. It's not really a VAT. It allows a deduction for compensation. It does not allow immediate payment back from the government or refund or a credit. And in that sense, it's not like a VAT. And it's also unique in that it will replace the corporate income tax altogether. And that's really, really a significant point. And it's one of the aspects of that should be noted is the distribution effect of that kind of approach. And Eric mentioned the distribution effect as being important. So a corporate income tax is sort of a, it's a supplement of the VAT in most systems, and basically in every system that has adopted the VAT or a GST. And it deals with regressivity. It prevents a regressive tax because it deals with essentially the premium returns. And without that, there may be some issues there. This border adjustment tax would be structured under like a subtraction method VAT. So, and it's purposely like that to look like an income tax, so it doesn't look like a VAT. The only country in the world that's got a subtraction method VAT is Japan. The others all have a credit invoice method. So the subtraction method basically says, here's your receipts, take out the cost of goods sold, pay the tax on the balance. And in the case of the border adjustment tax, you take the receipts minus the capital expenditures, minus domestic inputs, minus wages, which is unusual, as I said, and then that's the tax base. So the points I want to get across are that even though the border adjustment aspect of this international regime is very well intentioned, that we'll go through some of the issues, and I'll just highlight some of them. It is so complicated, never been done before, and it obviously runs through the fabric of our tax system, that I don't think it can be recommended, certainly on a unilateral basis and in this kind of a short time frame for analysis. And I think I think the administration feels that. Although, and I will say, Trump in the Economist interview on May 4th, which then was released on May 11th, said, well, we're not really, border adjustment tax, we're not really considering that, or we're not really into that. But then Mnuchin, I think, said just some days later that everything was still on the table, and they weren't saying they wouldn't consider it. And so it's still out there. And I will say that as best I can tell from inquiries made, and that the House is still very much wedded to this approach. And one of the reasons is it raises revenues to pay for the goodies that they want. So the goodies they want are the rate reduction, full expensing, and so forth. And how do you do that without this revenue? We'll get to that. It raises revenue because the U.S. is a net importer. So because it's a destination-based tax and the U.S. is a net importer, it actually raises revenue. If the U.S. were a net exporter, or when the U.S. becomes a net exporter, it will lose revenue. The second benefit is that it largely, pretty much eliminates transfer pricing issues on cross-border flows from a U.S. standpoint, not from the foreign country standpoint, increases them from a foreign country standpoint. And it alleviates inversions. So it's not so clear that there's still not an advantage to have a foreign company. And that may depend to some extent on what other countries do to income tax treaties. Because if they decide that this is a violation of the treaty and to cut back on benefits, insist on renegotiation, the U.S. may not be such an attractive holding company jurisdiction, even with territoriality, if the withholding rates are too high. And then there have been, the third benefit that has been referred to has been walked back from by the sponsors, at least as best I can tell. It's certainly been muted in the conversation. And that is that it was touted as being a generator of investment and inflows of cash into the U.S. And the fly in the ointment there was when the economists piped up and said, there's going to be adjustments to the, to the foreign exchange rates, and all of this is going to be neutralized. And so we do not expect there to be any favoring of exports or disfavoring of imports. We expect it to be essentially the same before and after. So there may be an increase under the plan in investments in the U.S., and there likely will be, but it would probably be more as a result of full expensing or some variation of that than this, and the reduction in rates. So those are the perceived benefits. What are the issues? And this is, one could go on forever on the issues. I listed 16 of them. And within those 16, there are a lot of sub-issues, So I won't even highlight all the 16, but so I'll just start with how the Senate views this. Mark Prater spoke on Friday. Mark Prater is the chief tax counsel for the Senate Finance Committee. He spoke on Friday at the ABA tax sections meeting in D.C. And he said some of the issues that the Senate has that they want to pay attention to is, first, who bears the tax? And that's very unclear. What's the incidence of the tax? Is it like the corporate tax, which is thought to be, although data is very unclear, the people guess it's 75% on the capital investor, the shareholder, 25% on labor? Or is this one more on is it more on the shareholder, or is it on the consumer? And then is some portion, because of the wage deduction, that's not borne by the shareholder or the consumer because it's deducted, so that must be borne by labor. They're trying to figure that out, and it has a lot of relevance to, again, the distribution impact of the tax. A second issue they're concerned about is the impact on trade agreements. They referred to trade agreements, Mark referred to trade agreements. He did not refer to treaties per se. The trade agreements are obviously the GATT and the WTO, and of the WTO, and NAFTA and the free trade agreements. And most attention's been paid to the WTO rules that you cannot reduce tax on, you cannot reduce an income tax on exports. Literally, it says you can't reduce a direct tax, but then direct tax is defined as an income tax on exports. So then the question is this really a direct tax or is it indirect tax? And the foreign countries have already informally indicated they think this is pretty much clearly a direct tax because of the wage deduction. So they would say, look, compare it with the VAT. Here you get a deduction for wages, and you disallow the wage component or input of, in fact, you disallow everything on inputs, but among those things you're disallowing is the wage component. So you're treating the two unequally, and that by itself is sufficient, perhaps, to cause a violation. Now, there's been some talk floated and sort of informally recently that one approach that the House might take to fix this aspect of the blueprint is to disallow the wage deduction and replace it with essentially a reduction of the payroll tax. And that's attractive because it reducing the payroll tax is a very good political thing, and it's something that a lot of groups have been asking for. And certainly if they took that approach, or I think it very likely eliminates the GATT problem. It doesn't deal with the NAFTA and the free trade agreement issue, which they have a different focus. So they're trying to say that there's prevent any tax, indirect tax on imports. They use the term charges. So the question is whether this tax would be a charge on imports. I'm not sure these are considered the most important since President Trump has indicated his disdain for the NAFTA agreement anyway and desire to renegotiate it. The third thing that Mark Prater mentioned was the impact of the changes on other aspects of the business tax provisions and the business tax base. And that's a very complicated issue by itself. Now, there are numerous other issues, and I'm sure the Senate is concerned about these as well. I'll just mention some of them. Like I said, the economists expect that the dollar will appreciate, and doing so will offset the extra cost of the tax. So it's expected to leave the after-tax cost of goods the same on both sides of the ocean. So if that's right, the retailers and other major importers that have been concerned about it should not be hurt. The theory is the strong dollar means that the exporters have less profit, but they're not taxed on it. The importers report more taxable income, but they pay less because of the higher dollar, and they will pay tax on that, and that offsets the benefit of paying less. Obviously, it's easy to say it. Economists claim they have proven it by equation, and we won't go into that. So in effect, the U.S. is by enacting this, it would be causing the dollar to appreciate, and then it would be taking a slice from the imports, and giving a slice to the exports. And that's, like I said, that's expected to raise revenue net. You can see that it would only raise revenue if the imports are greater than the exports, and only for so long, and only to the extent that the imports are greater than the exports, which is thought to be always a temporary thing. Temporary can mean 10 or 15 years, and in this case, I think projections are we'll be a net importer for at least, 15, there was still projected net revenue for the next 15, 20 years, I don't know. That can change very dramatically based on reactions of taxpayers and businesses, and I'm sure that number has varied all over the place. So I do recall one of the revenue estimators, one of the private organizations, had a number as low as $1/3 of a trillion, whereas as revenue generated, whereas the official estimate is closer to $1 trillion over 10 years. I think that, well, we'll get into how that interrelates, or maybe we'll get into how that interrelates with the cost of the expensing provision. But there's a risk that it won't fully appreciate, and to that extent, obviously, the importers are very concerned. And one of the complications, and it's a little hard to get your arms around, is that if you have partnerships, which are major businesses these days, and S-corps, which are certainly major businesses in privately held context, and they do export and import. If you have these guys taxed at 25% and regular corporate rate 20%, it's hard to see how both are going to be made precisely whole, even on that basis. And then there's the timing issue, which has been written up about quite a bit as to how soon, if there is this FX adjustment, how soon it takes place. Now, let's say everything works hunky-dory, there is an FX adjustment, and it takes place quickly. Is that the end of the problem with the effect on flows? There's one little problem, and that is that if that happens, then there's this huge, everybody agrees, the economists have said, there's this huge outflow of wealth from the U.S. It's a drain, it's an effect on the assets. So U.S. persons holding foreign assets are adversely affected because the value of the dollar has declined, the value of their foreign asset position has declined, and foreigners holding U.S. assets are in the catbird seat because the value of their U.S. assets has increased. So you've got a bad result either way. You either have that bad result or you have the failure of the exchange rates to adjust so that importers are adversely affected. And you're sort of saying to yourself, well, I can't, this is like, I can't even pick my poison because I'm affected one way if I have assets, I'm affected a different way if I'm an importer, but it's going to be bad for somebody. Now, the fact that there's general parity at the level of consumers, as the economists would say there is, sort of brushes by the fact that there's a lot of, that's on a macro basis, it's on a after foreign exchange rate adjustment basis, it's on an after-tax basis. So obviously there's a lot of room for differentiations. And one example is the taxpayers that are exporters that have a large amount of losses generated as a result of expensing. So this system is combined with expensing. They get to expense all of their capital expenditure and inputs, inventory as well, even on the portion that relates to exports. So by definition, since the exports revenues don't go into the tax base, you just have a big deduction on the export side of things, and that can exceed the tax base on the rest of their income in some cases. It's a bigger problem for smaller companies than for larger companies, but and I think it was thought that even 10% of the larger companies would have this kind of a situation, and about 50% of smaller companies would. So what do? They have to monetize those losses. The economists would say, well, that's not such a bad thing. We really wanted it to be the benefit of the border adjustment to be refunded, to be paid back. And if you don't, you're essentially saying you have an uneven system because you're saying that the expensing is not really a full expensing for exporters. So if you're going to have an even-handed system, they're going to have these losses. They should be allowed to monetize them. So does anything go? That's a big question. If anything goes, they can do lots of different games, as has been pointed out, including just round-tripping, making sure that the loss company buys the import, the profit affiliate sells outside the U.S., and it may involve different groups, not necessarily affiliates, but it could be done inside the group as well. And there's a huge question as to whether that'll be tolerated and whether it'll be felt to be benign. But at the end of the day, there probably will be fences around it.
So, Peter, can I ask you, should we figure all of this out before we jump, or would we be better off jumping? Because you could actually imagine less political resistance as long as people don't know how it's going to affect them.
Yeah.
And when everybody knows who the winners and losers are, you get the political deadlock that we've experienced now for so long. I have other problems with some of the things that are not specified in what we've been calling the blueprint.
Yeah.
But why not just leap if it seems like it might be a good idea?
Yeah, I think that was certainly, we shouldn't say. It's been speculated that is often part of the strategy of legislators that have a legislation to enact, that you don't always want to give people too much time to raise objections or nothing will get passed. I've already indicated that my feeling is in this case, because it is such a major part of the system and it is so complicated and is so novel that we just can't, we shouldn't be rushing into it. We'll see. I think I guess I did want to refer to just a couple of other things that are, I mean, certain industries have to be carved out, obviously. Think of the leasing industry, but also just think of the transportation industry. So should you have a different effect? Should you be paying a tax to ride on Lufthansa instead of on Delta, let's say? That makes no sense, or at least I don't think it does. We have internet transfers, so business or even just package delivery imports direct to customers. The basic approach of the border adjustment provision has been to say you don't get, if you're a business, you don't get cost of goods sold deduction included, or you don't get a deduction for service payments or royalty payments. But what if it's a business to consumer? The only person in the US is a consumer. We have to create a whole new system to deal with that. We have to either require the foreign sellers to register and pay the tax in the US, or we have to require some sort of withholding against the amount paid by the consumer, in which case the foreign seller may ask that it be grossed up and the consumer bears the tax. But none of that is simple. Never really been done effectively. The VAT systems have had to struggle with that to some extent. I think I'm probably I should be running out of time, but I haven't quite yet, I see.
We'll have another bite at the end.
I'll just mention what Eric mentioned in terms of the state taxes, hugely important, and financial statements, financial books, hugely important. Companies are going to have to keep many different sets of books because they have different tax regimes for financial accounting, different tax regimes for states that conform versus states that don't conform, for earnings and profits and so forth. So extremely complicated. So the things so we cut through the rest of it and say, what are the alternatives? Well, one alternative is being floated is, can we have a 50% BAT, 50% border adjustment? And could we, that's all that's officially been floated. But another possibility is, well, could we just get rid of border adjustment and simply scale down the expensing? We don't need 100% expensing. Maybe it's 50% expensing. Maybe it's bonus depreciation or something like that. Keep the net interest deduction, maybe not have the rates reduced quite as much, and that could work as well. So I'll leave it at that.
Okay. Well, when I was first asked to be a part of the panel, or even before that, when we were trying to figure out what the panel might be, it occurred to me that we needed to kind of ask the question, is tax reform ready for outside the Beltway? I remember back when I was in practice, and this was a long time ago, but there were many changes, if you can remember, in the late 70s and early 80s. And you were pretty much told not to worry about it until there was a proposal that you could actually anticipate getting in the way of the way a client was doing business, or was going to change something that was on your desk, to wait till it's a little bit further along. And with so many things that are not normal about the political situation now, okay, which parts of the procedures that we are used to are people going to be using? Which parts of the old way approaches to scoring, whether they're the old or the new old, are any of them going to be implemented in the same way? It's my understanding that we still don't have some of the people in place in Treasury who would usually be involved in this kind of an effort. Given that, wait a minute, is tax reform real enough to be considered, if you will, outside the Beltway? And it's pretty clear to me that the answer is that it has to be. That if we've got a president willing to promise the biggest tax cut ever, and content to leave us not knowing who he's making that promise to, it behooves us to try to find out who he's making that promise to, and to figure out a little bit more about what our common goals in tax reform should be. And the more we discuss things outside the Beltway, whether it's getting down in the nitty-gritty of very novel but intricate proposals, or whether it's merely trying to figure out what if we could measure the outcome, we would be happy with the outcome, we should be doing both of those kinds of things, both the very technical, whether it's legal or economic, and the more less fine-grained political. We really do need to engage. And one of the ways that I thought that I could engage was in the fact-checking exercise about what it would mean to have the largest tax cut ever. I despaired of there ever being an appropriate measure for what the largest tax cut ever would be, because the way a tax cut is scored and presented to the public does not always reflect what it actually does. And we just don't have very many numbers to tell us what any particular piece of tax legislation actually did, rather than what it was predicted to do. But I did stumble across one that I thought, I don't know which way this is going to go in the fact-checking, but when the Federalists' land tax was abandoned by Jefferson, who had in fact campaigned on the abandonment of this tax. There was a Federalist land tax. The federal government did collect a tax on real property, and they were booted out because of what it meant, not just in terms of the taxes that were paid, but the bureaucracy that it created and the vision of the federal government that would have been involved. When the Jeffersonians turned their back on this source of revenue, they were abandoning 20% of the then federal budget. That's what they wanted to do.
Charlotte, if we're talking about absolute dollars, the Boston Tea Party was a huge tax cut too.
But that was never a tax cut if you count what was being collected compared to what the change was. So again, we get some serious measurement problems when we try to do this. But meaningful tax reform is hard to get our brains around when everybody seems to have been promised a tax cut. You just can't do that, can you? Well, unfortunately, maybe we can pretend that we do. We have lots of instances in the last 10, 20 years, and maybe I've just been naive in the ones that, in the way I've approached federal tax legislation in the past, where Congress does things that, yeah, okay, we're going to get rid of cash-rich spins. Really? Did we get rid of cash-rich spins? I don't know that we did. With a Congress that's willing to pretend that it's doing things that it doesn't really do, I mean, maybe they can pull off something that looks like a tax cut for everyone. But I think we just have to take this whole process more seriously than letting Congress do that. And one of the ways that we need to do that, I think, is to realize that we actually have some serious limits in the way we can define tax bases. That as long as, what was the metaphor we were using last night? As long as we draw cartoons in the sky, particularly with the help of economists, and pretend that we have just printed a lithograph, right? As long as we imagine tax bases that are based on piles of paper in lawyers' offices, those partnership agreements, those LLC agreements, whatever they are, as long as we pretend that we have defined a tax base that never touches anything real, we're asking for trouble. Let me give you an example, another example from history. When the British first adopted the income tax in the turn of the 19th century, it was not because some economist had told them that it was principally the right thing to do. They they adopted the income tax because the land tax, a tax that was more like our real property tax, couldn't collect any revenue because the matching of the value in the tax base with the source of cash just wasn't there. And the people who were supposed to be collecting it were in effect collecting it from themselves and their brothers and their cousins, and that didn't work either. So they went to the income tax because what the income tax was at that point in time was an interception of the revenues being paid by tenants to their landlords. There was a payment already being made. The income tax, when initially developed, was a diversion of those revenues. My point isn't that we should return to what Jefferson abandoned and adopt a federal land tax. My point is only that we have to make sure that when we define a tax base, particularly one that's been handed to us by economists, we've got to make sure that we can technically make it work. To give you a graphic example, and maybe this problem has been solved, and I'll retreat if it has been, but you can't have a tax that denies a deduction for imports and allows a deduction for domestic inputs without knowing what you mean by import. You have to come up with a technical way of distinguishing imports from everything else. And if you can't do that, if you can't put the idea of import into something that has some reality in the real world, right? It came off a ship. Right? You're asking for trouble in defining a tax base that relies so heavily, at least as I understand, it relies so heavily on the concept of import.
How about services? I mean, there are many questions about services.
Services, inputs
Where
from.
is the service?
I mean,
Where is the service being imported or exported?
Mine was just the.
What about income from intangibles?
Well, we could go on and on, but we've got to recognize that we can't make those definitions be what the economists would want us to have them be and end up with an administrable system. Because what the economists and all of their equivalences would come up with doesn't describe very much in the real world. Now, mind you, I'm not telling you that we should abandon paying attention to what the economists say we're doing, right? Their analysis is critical, even if it ends up being indeterminate. We ought to have some notion of what we're doing, but when we rely on them too much for, oh, don't worry about that because it's the same thing as this, okay, they told us that Roth IRAs are the same as regular IRAs. Well, okay, that would have been true if the drafters had been more careful when they defined the limit in what a Roth IRA could, how much you could put into a Roth IRA. They didn't do that with any care, or I could be cynical enough to say, they did it with so much care that nobody noticed that they did it wrong. But more importantly, it only works if nobody cheats. It only works if you can't put assets with supernormal returns into a Roth IRA. There are a lot of very famous people's tax returns that show that you can cheat on those, what you put into a Roth IRA, making them not anywhere near equivalent to a regular IRA. Okay? Maybe that was a cheap shot, that example, but there it is. I have one more comment, which is, you know what? There are gonna be losers. Even if it looks like everybody's gonna get a tax cut. there are going to be losers, and we got to manage the politics of the losers. And here I'm going to really be Pollyannish. You know what? Nobody has to do business in a pass-through. They may be doing a business in a pass-through now, but nobody has to do business in a pass-through. So if you don't like the idea that corporations are going to get taxed on their income at a 15% rate while you're still stuck at 35%, there's a solution. Put your assets back into a corporation where we can impose a tax that is administrable instead of letting the abomination that is now pass-through taxation continue. Eric, would you like to comment? I'm done.
If you don't, I'll comment.
Well, let's first, okay, we'll stick up here for a little bit. I promise we'll ask questions in just a second.
I 100% agree that there's a huge issue on the differentiation in rates between the pass-through, the proposal for pass-throughs and corporations, and it cuts both ways, of course. If you have the corporate rate too low, corporations are taxed at that rate even on non-business assets, so you put collectibles into a corporation with a low rate, and we don't really have an effective personal holding company tax or accumulated earnings tax, so you have that issue. With the pass-throughs, yeah, everything becomes, if you say we can disregard the second level of tax and we want the same 15%, that's an issue. Now, that's the Trump plan, and without any reference to reasonable compensation. And that's why that one cost $4 trillion or whatever you said, Joe. $2 trillion. But with the, with reasonable compensation will be arbitrary. I think they're talking about now.
Okay, hang on. Let's unpack what we're talking about, I think, because we're talking about a corporate tax with a second tax, or we're talking about a pass-through tax where if the income you're reporting is from a pass-through, it's at a better rate than individual, but not as good as corporate. And the problem with the distinction between either of those taxes at the individual level and the tax that attaches to compensation, right?
Yeah. So now, just to be clear, the proposal is 25%. The blueprint proposal, let's take that, because the Trump proposal was just 15% pass-through. Why would I ever be in a corporation if I get 15% in a pass-through? No reasonable comp. That's obviously it's obviously a flawed proposal. The House blueprint at least has a higher rate than the corporate rate. So they're trying. That's one approach, which is create a blended rate that is not so out of whack that one has to pay a little bit more if there's a double tax, but a lot of the second level is held by tax exempts, and in any event, it's not distributed currently, and there's a time value aspect to that. So, maybe it's not so bad. The other approach, which I actually like, but is it worth the complication, is sort of an integration approach, and I think we may hear more about that again if this goes forward, because it's the only way to make sense of the pass-through situation. I don't think you can. I hear what you're saying about, and I agree with the Pollyannish aspect of it. Super optimistic, or unrealistically optimistic, that. We're just too far down the road to go say, we're not going to have pass-throughs be a predominant part of the economy, and most countries have that to some extent anyway. We have it to a greater extent. So what can we do? What we can do is not penalize public corporations, not penalize private corporations that, for whatever reason, didn't elect to be an S corp, couldn't, or didn't form as a partnership. Why penalize them with a higher tax? Why not create a system where they're in parity, so the form of business organization is neutral? The reason why it hasn't been done is because it's pretty complicated, but the Senate's been working on it quite a bit, and we'll see what they have. I mean, the notion is dividends. You can either do a credit or a dividend, like Australia does. Australia has an imputation system. This is not unheard of. It's been done. It works well. They also have a fairly high tax rate, I think, 30%. So there's a lot of things the other is dividends paid deduction, and I think that's sort of the one that the Senate Finance Committee probably favors, and then with a withholding tax on tax exempts and foreign persons. And you know, it's sort of it would have a nice result. It probably has complications, but anyway, that would be what I would say on that. I definitely agree, but in the interest of time, I couldn't get to all the things on the definitional issues with regard to the border adjustment. But I think their approach is actually fairly administrable and realistic, but it results in a lot of room for, you know, not very economic results and also abuse. And that is just look at where the person is.
I've got to interrupt you guys.
We're done. We're done. We're done.
I'm sure you'll get the chance to do it again, but I do want to make good on my promise here and ask if anyone has a question they'd like to ask. And remember, if you do, when you stand up, just please identify yourself and where you're from.
I'll start.
Jeff.
Jeff Sheffield, Northwestern. Let's assume that the border adjusted tax is a bridge too far and it goes away. Everybody in this booklet seems to agree that they would like to move to territorial. So let's assume that's going to happen. Okay, let's assume everybody also in this book agrees that they want to reduce the corporate tax rate. Put aside integration for a minute, 25, 20, 15. How much of a revenue loser is that? I mean, just sort of looking at that package, is that a realistic package to come out of this? Does expensing fall aside? Or is expensing just paired with interest deductibility and they sort of go together hand in hand? In other words, kind of what is a likely outcome on the international tax side of this process?
You're going to have to do something about base erosion. If the border adjustment provision falls aside, you're going to have to do something about base erosion. The question is, what are the options for base erosion? There have been various options proposed, for example, in the camp draft, which all revolve around a minimum tax, which has not been received favorably by various parties that would be affected by it. You'd have to consider other alternatives to deal with base erosion. But in terms of the revenue cost, I think that would be a very important aspect of it. Because otherwise, as everyone recognizes, that if you have the ability to shift activities and income offshore, it allows for the erosion of the U.S. tax base, and you're going to have to do something about it.
Yeah, so the interest, if they could make the disallowance of net interest expense stand, that would raise at least $1 trillion, I think, in each 10-year period or something like that. It actually increases for some reason in the second period. I'm not sure why. I wish I actually left some numbers in my briefcase, but I think that I don't remember how much the expensing is, but it obviously can be moderated, and that's what I was just saying. You can gear it back. You say, okay, it's not 100%, but it's a very investment-oriented package at the end of the day still. You know.
And yet they're really counting on expensing to deliver on the growth promises, right? I mean, and full expensing, because given the growth framework of this whole debate, this 3% growth or whatever that we're likely or might see, it seems to me like that will be a hard-fought battle. That's something what they're going to want. That's what the House is going to want to hold on to, I think. I mean, does that strike you, or do you really think that some scale back on that?
I had heard that among these things being floated was even thinking about maybe we just go to 100%, maybe we go to shorter lives for makers, maybe we go to 100% bonus depreciation, maybe we just keep the 50% bonus depreciation. I think it's all on the table, and then as your colleague Marty Sullivan said a few days ago, usually you don't pick a time when the economy is growing as it is to pump, prime the pump, but we'll see.
So I have a question that we haven't touched on yet. One way to give everybody a tax cut would be to tinker with the payroll tax and might even be to implement, and I believe that I heard a rumor of this, to implement the child care benefit, which I understand is not because 30 years of my classes know that, of course, childcare is just as much a business expense as a $200 bottle of wine is, and therefore ought to be treated that way. But the proposal to make the childcare a refundable credit in the income tax doesn't really, I don't see that getting much traction, because there's another, well, entitlement would be the wrong word to use, but wait a minute, that's putting a lot of people in the same position that getting a subsidy through the income tax. But making it non-refundable and putting it in the payroll tax, is the payroll tax sacrosanct against garbage like that, or not?
I think you're right. I think the Trump proposal was to make it refundable against the payroll. I mean, to make it creditable against the payroll tax.
And therefore, it wouldn't need to be refundable.
But certainly, that would be a break with the way we've treated the payroll tax for 80 years.
Well, it used to be an insurance.
That was actually kind of a lie, even at the beginning. But
Thank you.
any more questions from the audience? Yes.
This is probably more of a process question. David Cameron from Northwestern University. More of a process question. The point was made, I think Eric made the point early or Joe, that we haven't had tax reform since 1986. And I actually went back. I'm sort of curious as to what we even mean by the term tax reform. I went back to the Tax Policy Center. They have a list of all the significant legislation over since 1950. And it's interesting, between the enactment of the 54 Code and the Tax Reform of 1980s, the Tax Reform Act of 1986, there were 20 pieces of significant legislation during that 32-year period. And this is following the 54 Code, two of the acts, the Tax Reform Act of 1969, the Tax Reform Act of 1976, and then the Tax Reform Act of 1986. And we haven't had, that's, as I mentioned, 20 pieces of legislation. Since 1986, in the, 30-year period, we've had 46 pieces of significant tax legislation, none of which have been referred to as tax reform, at least over the last couple decades. With the names of the acts, tax relief seems to be the most popular. 13 of those acts have the term tax relief in it. I'm just what do we typically mean by tax reform? At least in '86, it was lower rates, broaden the base. That was sort of the mantra, and that's the way you can accomplish tax reform. I mean, clearly we've had tax reform over this 2-decade period. We've got an awful lot of tax legislation. I mean, what are we attempting to do?
I think it's because there's got to be something transformational about it. At least that's the way I look at it. Dramatic or transformational, pick your term. I think if you deny the interest deduction, that's pretty dramatic. And if you have 100% expensing, so basis becomes irrelevant for income tax, that's pretty dramatic. That's reshaping or reforming or the tax system. I was curious, you didn't mention the good old, that we won't hear another tax bill called the Deficit Reduction Act of 1984.
I mean, well, I would also think
Doesn't
the
have the same
transformation
appeal.
is what might happen on the international side, which is moving to a territorial system. You know, there will be potentially some lower rates, broadening base, but I think moving from our current deferral system to a territorial system, in whatever form that will be, would be considered transformational. That would be a huge change for us, particularly since the nature of the global economy is changing.
So by this definition, then, 1981 would qualify as tax reform, right? Transformational, get rid of,
The Economic Recovery Tax Act?
Yes.
Or to-
Not only cutting rates really dramatically, but also indexing, which really changed the whole fiscal debate in Washington forever. And yet, most people don't look at 81 as that. They say, oh, that's the giveaway year. And then 86 is the, like, come to Jesus year.
Well,
right?
82 already,
Or 80 or
82 and
82,
84 are taking back on 81.
I'm actually, I wish we'd stop talking about tax reform, because I wish we would just talk about the specifics of it, because it's this normative frame that we lay over a bunch of proposals that we like, and we refer to everything else as what's not tax reform. And I just don't think that really advances the debate very far. Because for a long time, tax reform really didn't mean the sort of classic 86, broaden the base, lower the rates tax reform. It's meant that probably since the 50s. But for a long time, even in the 50s and 60s, that was tied up with a notion of making the system more progressive. And that really was the animating impulse behind Stanley Surrey. And I think that we need to stop. I think we need to stop fetishizing that definition to begin with, but also just we need to recognize that tax reform truly in the eye of the beholder, and we are much better having a dispassionate argument about the specifics. If I'm pressed, I go with transformational, not as good, but as different.
So, but my answer to David's question would have been, it's tax reform if it had a goal other than being popular with the taxpayer. And that goal implicitly in some of the things that you listed initially, Eric, one of them was efficiency. But at that point, it seemed rude at the time, so I didn't. I wanted to interrupt you and ask you, what is the definition of efficient there? I think that economists looking at taxes just use efficient to mean non-distortionary. But hang on, taxes are distortionary. So what do we mean if efficiency is a goal?
I would say promoting economic growth by, for example, capital incentives and lowering marginal tax rates.
So having the tax drag be as small as possible.
Would be helpful. Reducing distortions would be important. Reducing distortions of our international system, of our deferral system and the lockout, that would be a step in the right direction. So those were all the aspects that I would think would be the objectives of this tax reform.
So would it be more possible to agree on goals? Would it be possible to agree on goals? Does tax reform require us to agree on goals? Or do we just blunder on through and, okay, you got this, so I get this, and we'll give them that if there's anything left?
Well, we should do our best to achieve the objectives I listed. One other objective that would be important is looking forward to 5 or 10 years from now when we will have the budget deficits that we'll have to address.
Yeah.
And all of those things have to be put together to try to put together a package.
Yeah. Yeah, so Mark Prater said, one of the things he says that the Senate would be guided, at least the Republican side, would be guided by the, but I think the Democrat side too, what he called the Reagan principles of efficiency, fairness, and simplicity. And, but those are all in the eyes of the beholder. So I actually think you do have to, as a political matter, get down to the specifics before you can be realistic. And you were saying that too before. You wanted to be real, right? So I think you can't talk in abstracts too much. But in terms of what the economists view as, the most efficient aspect of this proposal is the expensing, because that eliminates in their views, it eliminates the favoritism given to to the different depreciation ranges you have for different industries, and that's something. So intangible assets would be expensed immediately, just like capital goods and so forth. So they view that as sort of efficient. Tax doesn't drive the allocation of resources.
I would also just say one other objective is to move forward on this. But as I say, the tremendous uncertainty that we're experiencing right now, I think in terms of investment, in terms of transactions in the business community, I think moving towards an answer, moving to some sort of compromise is a goal in and of itself.
I mean, just last week, I think it was in Tax Notes, Marty Sullivan, who I think, it's too bad he's not here because no one here is defending the border adjustment tax. but Marty would if he were here. But what he said was, he says it's a done deal. It's gone now because the administration won't support it. And he said the sort of the saving grace of that is that we've reduced uncertainty by several orders of magnitude by ruling that off the table. And now we have a tax reform process that looks much more familiar because that sort of transformational replacement of a tax is extremely destabilizing and raises so many questions that it's a problem in its own right. Any other questions? Yes.
Hi, it's David Herzig from Valparaiso. So along those lines, I have a simple question, which is, who's driving tax reform? Is it Munchin and OTP? Is it Cohn? Is it Ryan? Because to answer Charlotte's question, I can do anything. I can bust the filibuster in the legislation. I can have unlimited deficit. I don't even need to worry about budget windows. I can have budget windows that go out 100 years. I can do anything I want to do through any process. The question is, who's driving the process? And I didn't know if there was insight on that.
The next step in the process, based upon the announcement by the Trump administration at the end of April, my personal expectation is that there are going to be consultations between the administration, which includes the White House and the Treasury Department, particularly with the House Ways and Means Republicans to try to reach a consensus. Presumably the Senate Republicans will also be involved in this process to move forward towards a consensus and then to prepare and to publish a bill. I think the dynamics changed somewhat by reason of the announcement by the White House. It had been driven through the blueprint, through the House Ways and Means Committee, but I think it shifted some so that there will be a consensus building between the administration and Congress.
Any more questions? I want to ask one last question. I mean, are you all writing off the border adjustment tax? I mean, we spend a lot of time talking about it, and we should because it's a big deal. It's a big idea. But I mean, can you handicap it for us a little bit? Is this just done? Are we engaging in an academic exercise here, or is there still a possibility? I mean, it raises an awful lot of money, at least over the near term, and they're going to need some of that probably. So, I mean, I've seen statements made, reports of its death are premature. And do you agree, or what do you think?
I think it should be, and so when you go through it, you think it should be. But even Marty, who is, I guess the last I heard, he thought there was a 10% chance of it. And then subsequently, I heard there was this talk of maybe a partial, which makes no sense to me because you have all the complications in half of the result, and maybe one half of the result because the results it puts too much at stake. But but before that, we had, the talk was much higher than that until very recently. It's only very recently that it dropped. I mean, it was always less than 50%, but 10% is recent.
Well, the last time they tried to actually replace the corporate tax entirely all at once was in 1936, and they all freaked out. And I think, somebody, I was at Charlotte, said maybe we should do this stuff quickly before people really figure out what's going on. I actually think businesses and organized business interests are very good at figuring out very quickly what's going on. And they shot that idea down too. And what they did though, was they enacted a half measure, or actually more like an eighth measure. They created a symbolic version of the undistributed profits tax and left the corporate tax intact. They were looking for they were addressing different problems and had different solutions. But I think it speaks to the difficulty that is really much the same in 1936 as it is today in upending a lot of vested interests all at once, and mostly on the word of economists, which I think has almost never been done, that we've trusted economists that things will adapt and respond in the way that they say they will. That's a big leap of faith for anybody to take, I think. All right. One more last question? Yeah.
If nobody else has one. This is for Eric, I guess. I had heard that Senator, I guess this may also be from Prater's talk, that Senator Hatch is very much in favor of a bipartisan approach. And I thought Mark Prater said, and as a result, he would not support a reconciliation measure, the reconciliation approach. So he's on the Republican side, Orrin Hatch from Utah. I don't know if you've had any reaction to that or heard anything like that, because that would.
Yeah, I think it's going to come down to whether the Senate Democrats, how they feel about lowering rates for high-income earners. And if they can't get comfortable on that issue, I think it'll be very difficult to do it in a bipartisan way. It'll be extremely, I think, positive and favorable if it was a bipartisan bill. The dynamics of the political system right now may make it difficult.
But then Senator Hatch would have to drop his objection then to the working on a budget resolution for that, I guess, reconciliation. Okay.
All right, well, we're out of time. Thank you very much for coming, everybody.